Welcome to Channels Business Global with me, Juliana Olayinka, from our studios here in London. Over the next half an hour, we'll be looking beyond the business headlines by giving you in-depth perspective on the stories that are affecting all of us. Coming up on today's show, BP has become the first oil major to declare that the relentless growth of oil demand is over. I'll be discussing the implications of their findings in their Energy Outlook report with Dr. Jide Agunbiade, a director at National Oil Well VARCO. And the world's biggest online retailer announced earlier this week that they were recruiting 100,000 more workers to keep up with the demand of e-commerce, which has surged during the pandemic. I'll be discussing the future of consumerism with the founder and CEO of More for Africa, Chris Folayan. Then later, I'll be speaking with Vincent Rouget, an Associate Director at Control Risks, about the recent findings in the latest Africa Risk Reward Index, which examines and reveals the longer-term implications of COVID-19 on the continent. Before those discussions, here's our business correspondent, Simon Pusey, with a breakdown of the biggest business stories trending in Britain this week. Simon, earlier this week, UK unemployment figures were out. Historically, not as bad as some may have thought it could be.
Yeah, the unemployment figure, the rate at least, has gone up slightly from 3.9% to 4.1%. And like you said, that's not as bad as some people had thought. But it is still bad for younger people, especially those between the ages of 16 and 24, finding it really hard to get jobs. The UK Chancellor, Rishi Sunak, says his number one priority is helping people get back to work or finding new work. And lots of people are wondering whether he's got some kind of employment scheme up his sleeve that we haven't seen yet. Members of the opposition party wondering if some kind of new furlough scheme might come back into force because unemployment is going up. But in a briefing to the Cabinet on the economy, he reaffirmed his decision not to extend that furlough scheme, saying that it was unsustainable to keep giving money away in that kind of fashion. New data from the Office for National Statistics, meanwhile, showed that firms continued to remove staff from payrolls. Around 695,000 people disappeared from payrolls of British companies since March, when the coronavirus lockdown began. Now, this is the sort of initial fallout from that coronavirus. This could go on for many months. And I think what a lot of people are expecting is when the furlough scheme ends in October, that's when companies are really going to struggle to hold on to their staff. So that's why the opposition party are thinking something needs to come in, because it's not like the world's going to go back to normal after October. But it looks like Rishi Sunak, the Chancellor, is standing firm there. 156,000 fewer young people in employment in the 3 months to July compared to the previous quarter. So it's not looking great. But as you said, it's not the end of the world. It's not as bad as lots of people had seen. Meanwhile, inflation rate has fallen. That's good for consumers and borrowers, bad for savers. So lots going on at the moment. But yeah, I think in general, the figures aren't as bad as lots of people had expected.
Simon Pusey, thank you. Oil consumption may never return to levels seen before the coronavirus crisis took hold. That was a damning statement made by the oil major BP earlier this week. Even its most bullish scenarios see demand no better than broadly flat for the next 2 decades as the energy transition shifts the world away from fossil fuels. The coronavirus pandemic shattered oil consumption this year as countries locked down to prevent infections from spreading. While demand has since improved and crude prices with it, the public health crisis is still raging in many parts of the world. For more on this outlook, I'm now being joined by Dr. Jide Agunbiade, a director at National Oil Well VARCO, a global leader in the design, manufacture and sale of equipment and components used in oil and gas drilling. Dr. Jide Agunbiade, thank you so much for joining me on Channels Business Global. According to BP, global oil demand has reached its peak. Do you think that's a fair statement?
Yeah, I think it's a fair statement. First of all, thanks, Juliana. The theory that the world will someday come to rely on less oil is not new. However, the way that outcome may occur has shifted from peak supply to peak demand. And what we're seeing now is demand is dropping as electric cars and it boasts a whole lot of renewable energy option, integrated gasification in combined cycle from coal, and all the rest of them have come into play. So absolutely, the demand has peaked. And it's a fair statement.
How does this affect sub-Saharan Africa? I'm sure you have. I certainly have been to so many different events pre-pandemic where this is a topic of discussion. Oil is a dirty business and the big giants are looking for ways to clean up some of the mess they've made. But it doesn't appear as if this discussion is taking place on the continent, or is it?
It's not taking place as much as it should be. And if you look at sub-Saharan Africa, along with China and India, these are places where demand is rising. You know, in the developed world where you are in the UK, North America, and all the rest of them, a lot of new technology is coming into play. Like I said before, electric cars, windmill, clean energy, clean coal, and those are really, really dropping supply. But in Africa, we still have a lot of need for oil. And, you know, what operators and service companies are doing is to optimize process, try to help reduce costs, you know, so that we can still continue to produce oil. And don't forget that a lot of these African countries, they depend substantially on oil revenue for survival. You know, something like 90% of external reserve for Nigeria is coming from oil, the same thing in Angola and Ghana and all the rest of them. So the initiative is not really being taken in sub-Saharan Africa. There's no push towards doing anything different. You know, they're still aggressively trying to source foreign exchange, which for the most part, they can only do that through oil.
Nigeria's crude oil output is rising despite the reduction in global demand. And you spoke about the dependency. Does that worry you, or as a big oil and gas man, are you happy that Africa seems to be ploughing ahead, even if the world is shifting its focus?
Well, you know, that restriction that has been placed by OPEC and all the rest of them, even though, I mean, the way that you put it, Nigeria has the potential today to produce 2.1 million, 2.2 million barrels of oil. But, you know, the restriction put in place by OPEC just to shove oil prices means that we can produce beyond 1.5, 1.4 million barrels of oil per day. So we have excess capacity. But, you know, with our long-term ability to produce more oil, we definitely need the foreign exchange, you know what I mean? And if people are coming in, investors, IOCs, and everybody's playing their little part to drive down drilling and exploration costs, you know, so that these countries can make a little bit more money, you know, and then be able to satisfy their economic needs. So yeah, it's a catch-22 for African countries. They need the foreign exchange. They don't have a lot of options to earn money in other ways. So yeah, do I prefer that we look into other source of energy, you know, because, you know, oil need keeps going down? Absolutely. But I mean, given the current scenario, at least between the next 10 years, you know, that's the situation that we face, and that's what is going to keep happening, where I can say that, yeah, it's a good situation for Africa.
Well, Dr. Jide Agunbiade, Director at National Oil Well VARCO, thank you so much for joining me on Channel's Business Global. At the start of the year, online shopping was just an option for consumers, but fast forward a couple of months and the world of e-commerce has changed forever. Due to a surge in demand for online goods, Amazon has been on a hiring spree. Earlier this month, they announced 40,000 new positions in the UK, and most recently, an extra 100,000 positions are now available in America. COVID-19 has altered the habits of shoppers. For more on this, I'm now being joined by Chris Folayan, the CEO and founder of More for Africa. The company is an e-commerce platform offering millions of products from more than 250 global leading retailers to consumers on the continent. Chris, thanks so much for joining me on the show. I was just saying, Amazon earlier this week, 100,000 new recruits. Last week, they got an extra 40,000 in the UK. Clearly, e-commerce has surged online during the pandemic. Do you think the way people purchase their goods has changed forever?
I do. I think we were on this trajectory pre-COVID. But I think what COVID has done is it's just really accelerated the process. We could see that, you know, the Generation X and Ys were moving towards online sales. Quite a few stores closed in 2019. More stores are closing this year. And just literally due to the fact that most people are shifting to online purchases. It's easier, it's more convenient. Right now during COVID, it's safer. Yeah, I do think consumers are changing their behavior and the way they shop online.
Before the
shop in general.
pandemic, Chris, it was the Internet of Things. You know, the issue that we had is that there were too many options. Now, it's almost the opposite effect. I'm not sure what it was like in LA, but certainly in London in March, you couldn't get toilet roll, you couldn't get hand sanitizer, you couldn't get anything. How has it been for More for Africa? How have your supply chains been keeping people in Africa supplied?
Yeah, it's been tough. Honestly speaking, it's just been tough. Even if you just forget about those essential products that you've mentioned, just even getting people items, you know, essential or even non-essential items, has been tough. The airlines, commercial airlines, which, you know, flies in goods and products, literally stopped. You know, in Nigeria, they shut down the airports, and many African countries, they shut down the airports. And if you shut down the airports, you can't pretty much bring anything in. So, you know, the challenges were more on how do you even get items in, essential or non-essential, when airports are shut down. So it was hard to get products in. I mean, we're lucky to have DHL as a partner and investor in our company, so we were able to get stuff in via DHL. But it was tough. It was tough.
How did your relationship with your consumer, your client base change? Because, you know, the concept for More for Africa is almost perfect for such a situation. But then, of course, you know, there is no such thing as a perfect storm. But just explain, especially for viewers that will not be familiar with More for Africa, what exactly it does and how, yes, the relationship changed with your clients during this time.
Yeah, so More for Africa is basically a platform that helps people in Africa buy items from US and UK retailers. As we all know, many US and UK retailers don't sell into Africa for many reasons, from, you know, payment types, they are unfamiliar with the market, shipping, taxes, duties, and the list goes on and on and on, and fear of the markets. They just they don't understand the market at all. So you know, we've taken the approach of there's an app for that, and we've developed an app that allows people to shop on these sites, even though the sites don't ship to Africa. But with the More for Africa app, you know, whether they ship to Africa or not, or they accept, you know, local payments, it doesn't matter. Our app makes it happen. So we're there for people to basically buy the products that they want and aspire to from US and UK retailers, and make sure they get it into their hands, taking local payments. We take care of customer service, taxes, duties. We basically get that product that you want into your hands from the retailers in the US and UK. So that's what More for Africa does.
You've been quite open about, you know, the reaction you got from investors when you were first, you know, peddling this idea years ago. I'm sure many of them will be kicking themselves because they should have invested then. But one of your concerns was that, you know, they weren't so sure about the focus being on Africa and whether or not it would be a great reward. Given the fact that the supply chains have really been drying up, have you felt that sentiment rising again? Perhaps, you know, other companies getting a heads up before you perhaps were giving opportunities?
Yeah, well, more people are open to Africa now and other markets. What this pandemic has done is, as we just mentioned, it's opened up e-commerce, and people have seen, you know, things get really tough in their environment. So we've seen online sales surge. And when online sales surge, people start, you know, noticing that people outside their region want to buy products. So we've, in the past, we had to beg online retailers to join our platform. Now they're calling us saying, hey, how can we tap into Africa? You know, where business is tough here, things aren't doing too well. Can we tap into this new market, this market called Africa, and see if our products are valid and valuable there? And the answer is yes. So we've been getting quite a few phone calls and new merchants on the platform wanting to do business in Africa, which we've never ever seen.
Wow, given the scale of the job losses in the retail sector, in the UK it's 700,000 across the world. I'm sure it's millions. I'm sure those calls are going to keep coming and coming. Chris Folayan, CEO and founder of More for Africa, thank you so much for joining me on Channels Business Global. Coming up on Channels Business Global, I'll be catching up with Vincent Rouget, an Associate Director at Control Risks, about the recent findings in the latest Africa Risk Reward Index. See you after the break. Welcome back to Channels Business Global with me, Juliana Olayinka, from our studios here in London. In a moment, I'll be speaking with Vincent Rouget from Control Risks. But before then, here's some company news for you. Next has agreed a deal that will resurrect Victoria's Secret's UK and save 500 jobs. The British fashion to homeware retailer is to take a majority 51% stake in a joint venture with US-owned Victoria's Secret after the lingerie firm's UK arm was placed in administration in June following weak coronavirus lockdown trading that forced all non-essential stores to shut. L Brands, the company behind Victoria's Secret, agreed to the deal following a bid process led by administrators, which attracted interest from dozens of parties, including Marks & Spencer. Klarna, the buy now, pay later payment service, has been valued at $10.65 billion in an investment round led by US private equity firm Silver Lake. The Swedish company said in a statement Tuesday that it had raised $650 million from investors, making it the most valuable private financial technology business in Europe. Klarna said it will use the funds to invest further into the business and grow its global presence, especially in America, where more than 9 million consumers have used its services. The British government is under pressure to intervene in a $40 billion takeover of the country's biggest tech company, ARM Holdings. The US software firm Nvidia said on Monday it had agreed to buy Cambridge-based ARM, a global leader in designing chips for smartphones, computers and tablets, from Japan's SoftBank. If the deal goes ahead, SoftBank stands to make an $8 billion profit, just 4 years after buying ARM for $32 billion in a transaction that was cheaper thanks to the fall in value of sterling after the 2016 Brexit vote. Now over to our next topic. Specialist risk consultancy Control Risks and independent global advisory NKC African Economics have launched the 5th edition of the Africa Risk Reward Index. The report provides an outlook of key trends shaping the investment landscape in major African economies. Vincent Rouget is an Associate Director at Control Risks. Vincent, thanks so much for joining me on Channels Business Global. You don't have to be an economist at the EY Item Club to see that 2020 is going to be one of the worst years on record for a global recession. But there hasn't been much talk about what the future is or what the forecasts are like on Africa. We've been focusing predominantly on the global north. Just tell us a little bit about some of the highlights from your recent report.
Yes, absolutely. So we've just published an Africa Risk and Reward Index, and obviously this year it's been heavily influenced by the context of COVID-19. And what we wanted to do with this report was to look at the recovery and to look at what shape that recovery would take, what opportunities might arise from it as well. And from our research, it's clear that we are looking at a fairly prolonged recovery and a fairly uneven one across the continent. It will dominate the talk for the next few years, possibly the next decade. And African economies don't necessarily have the same capacity to deploy stimulus packages as their northern counterparts. So it will take a few years for many countries to bounce back. But at the same time, we also do see opportunities arising from this crisis and on issues such as the digitalization of the economy, for example. The COVID-19 pandemic, in a way, gives a boost to innovation. And so we think really that this is going to be a transformative time for Africa heading forward.
It's great that you talk about the opportunities. In part one of the show, I was speaking to an individual about consumerism and how consumerism has completely changed, especially Amazon. This week, they announced a further hiring of about 100,000 new recruits in America. And you did speak a lot about technology and the ecosystem in Africa. Do you think that is going to be a flash in the pan, or are we expecting the ecosystem to improve as time goes by?
So the ecosystem has massively improved in the last few years already. We're seeing tremendous innovation across all sectors. And really, if anything, COVID-19 has highlighted more problems for tech to solve and given a big boost to these digital applications, whether we're talking about e-commerce. It's a sector that we're seeing tremendous growth in the last few months because of the restrictions in the lockdowns in several countries. whether we're talking about logistics, whether we're talking about remote working as well, and the application of digital technologies for remote working in Africa, within African cities, and then perhaps even more pressing for development problems. So we're thinking about health solutions, agriculture solutions, mobile money. All of these, I think, have a very bright future on the continent.
Absolutely. Your report also suggests that COVID-19 will see the formalisation of the informal economy. You went into some detail about palliatives and COVID-19 handouts, economic support and stimulus. And of course, if you're part of the informal economy, you have to register for that interest. Is this something that will be expanded, or do you think this is, again, just a short-term solution to get people out of this issue?
Yeah. I mean, the formalization of the economy has been the main challenge, really, for African countries for years now. And it's becoming even more pressing now with the shortfall in revenue. So there is a need to broaden the tax base and to really bring more people into the tax net if you want to keep expenditures going. And COVID, in a way, has allowed or has given a bit of a boost to formalization, in the sense that indeed you've had to register people to get handouts. Some people, millions of people really across the continent, have for the first time been registered in one way or another, whether to receive treatment, whether to receive relief, whether to get tested for the pandemic. And so there is a whole infrastructure that through this has been built. And we can certainly hope that this will then be long-lasting and be then used for other purposes, the distribution of other social services, for example. But it is probably giving more momentum than has ever been, really, for the kind of formalization of this vast group of people that have been completely operating in the parallel economy until now.
Finally, Vincent, I was pleasantly surprised that the report focuses a lot on the African narrative and how disparaging that can be for investors. Because some people would call it conspiracy theories or not, but the narrative, does sway opinion. This is the 5th edition of the index. How has it changed? Are investors, realising that some of the information they receive is fake news? What advice are you giving to readers?
So that was certainly our intention with this index. We first launched it in 2017, and I think there were kind of multiple objectives. One was to bring attention to a lot of these frontier markets that don't get a lot of coverage. Another one was also to shift the conversation away from purely talking about risk, purely talking about the negative side of how it is dangerous or risky or perilous to invest. And we wanted to really balance this with also a conversation about reward, what it is to gain investing in those markets. This year is a bit of an exception because I think with COVID, a lot of the scores that we rate in this index have gone down. But in the last few years, really the trend has been quite positive. And I think what we have also achieved through this report is bring attention to some lesser known economies. Some large countries, the likes of South Africa, are justifiably on everyone's radar. But our index, consistently shows, for example, Ethiopia being a high reward country, Cote d'Ivoire in West Africa also having, very interesting growth dynamics. And so indeed, we do hope that, this is part of shifting the narrative, and I think, bringing really attention to some parts of the continent that have been fairly neglected until now.
Well, I absolutely agree with you. Vincent Roget, Associate Director at Control Risks. Thank you so much for joining us on Channels Business Global. Sadly, that's all we have time for today, but do get in touch with your comments and suggestions. I'll see you at the same time next week for more in-depth business analysis on Channels Business Global. Goodbye.